I think probably by that time, or like very, very, very likely by that time, there will be more infos about Lido v3. It is the staking vaults, but it's also more than that. I think it's a very, very compelling and synergistic vision that turns Lido from basically just being staked ETH to this platform where anyone can create staking products on top of Lido infrastructure that also benefit from staked ETH liquidity and integrations.
Hey everyone, this episode is brought to you by Uniswap Labs, who is launching the largest bug bounty program in the entire history of crypto. It's a $15.5 million program. This is aiming to be the most rigorously reviewed code base ever deployed to Ethereum. So if you want more eligibility on the scope, rewards, payouts, etc., just click the link in the bottom of the show notes, tell them that I sent you. You'll be hearing all about Uniswap Labs later in the program. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by friend of the pod, Hasu. Hasu, how are you, my friend?
Hi, Mike. Doing very good. Thanks for having me. It's Christmas Eve, right? So very special episode.
Yeah. Look at us, so dedicated, just not resting, giving the people the content they want, even on Christmas Eve. Nice.
Recording from our parents' houses, respectively. Very unusual, but
yeah, exactly. So we're not on our. So we've caveated this episode already going in. We're not on our usual game. We're at our parents' house. So lower your expectations here for the audience. It's Christmas Eve, but actually, I'm really looking forward to this episode because this is paving the way for another episode that you and I are going to do in 1 or 2 months on Lido v3, which I'm very interested to unpack the details there. But I thought it would be good to just do a review of the liquid staking ecosystem in Ethereum today and just do a review of Goose and GOOSE-2. And I want to give you guys credit here. I know you are the leader of the Goose set of objectives within Lido, and I think it's one of the, more, better kind of strategic, just formal kind of goal setting objectives that I've ever seen completed in a DAO. And so maybe we could start from a high level, actually. And before we get into Goose and GOOSE-2 and some of the details about what Lido is working on, can you just give us a state of the union of the liquid staking ecosystem in Ethereum today?
Yeah, so the liquid staking ecosystem in Ethereum. So I would say that I think things played out a little bit different than people expected. So I think a couple of years ago, there was this assumption that liquid staking was just a better form of staking in general, and it would be relatively smooth sailing from 0% market share a couple of years ago to 60, 70, 80% until eventually all the stake would be liquefied. And I think you can see why many people, me included, were believing that, because at the time every staking setup was basically looking the same, right? So if you go back a few years, there was it was before the merge, the beacon chain was live, but you couldn't withdraw. There were initially only consensus layer rewards, and there was no way to differentiate on staking at all, right? And so you had a very kind of homogeneous demand for what people wanted to get out, and like a very homogeneous supply for how to satisfy that demand. And in a market like that, staking is a commodity, and in a market that is a commodity market, if you can differentiate on the product, then it's extremely hard to beat you, right? And so the liquid staking tokens basically gave users access to liquidity and integrations at a time when that was extremely valuable. And then things gradually started to change, but not that much actually for a long time, right? So the merge happened, then execution layer rewards came live, which drove more rewards, bring overall a de-risked staking and made it more profitable. So more people started doing it. There were large inflows. Then MEV happened, but due to proposer builder separation, so this other project that I'm working on with Flashbots in collaboration with the Ethereum Foundation and now many other people, their MEV rewards also were democratized, right? So there was also no way to differentiate from an MEV perspective either, right? So even though some staking providers try to do that, they were saying, I'm using a different MEV strategy. I'm somehow making more money, but none of this actually started to play out, which is a testament to how well MEV Boost works. That it was never really possible at scale to get a bigger MEV reward than just connecting to the permissionless open MEV Boost. So I would say that's a huge success in that sense. But over time, I think things started to change a little bit, especially with I think due to two factors. I think the first is the rise of restaking. So restaking, just the idea that you have a staking setup, but you're basically like double pledging the stake to some other activity, and getting extra rewards for that, right? And there was Eigenlayer in particular, and they basically allowed people to lock up their stake. And Eigenlayer did something that was very, very smart. They didn't launch a liquid restaking token themselves. And now you could ask, okay, why did they not do that? I think they really saw the potential to make, and like, pardon my French, but to make like a super shit sandwich of like protocol incentives, right? Like the idea that, okay, if Eigenlayer does the restaking, but they also do the LRT, they can only pay like incentives once on that. But if they don't do the LRT and they have like, almost, these like 3-4 different LRT protocols working on top, then these are also going to launch their own tokens and like pay extra incentives on top. And you have this huge like sandwich of points that people can farm. And that is exactly what played out, right? Like people were effectively locking up, and like we have to say, this was all like way before. I mean, now today, actually, I saw that slashing is going to go live soon, right? So there are no rewards or anything for restaking, right? It's basically it was like crypto's biggest point farm for about 1 year, right? Like people just lock up stake in a contract, and they get points from Eigenlayer, and they get points from EtherFi, they get points from Renzo, they get points from Pafa and whatever, like all of these LRTs. And so it led to basically people wanting to use their stake for different activities that did not necessarily require LSTs. I'd say the other part of it is further fragmentation from the demand side, in particular on the a little bit on the institutional side, I would say. So like you always had, I think you always had exchanges, for example, that were, just had their own setups because they can really, charge. Their users were very price insensitive, and so they could charge much higher fees. And these users, they never had like an incentive to withdraw from the exchange itself. And so if centralized exchanges are strong, then that's always in favor of like centralized. That's always a tailwind for centralized staking against liquid staking. And so that, I think that we saw like a bit of a resurgence there. And then in the institutional segment, I think you had a bunch of players that were basically saying, you're not allowed, you can't use like a decentralized LST. You can't use DeFi. You need to use something that has this or that license. You need to use something that is has all of the KYC providers inside the US. And I think that is a narrative that worked somewhat well for a time, and it's one that is very dangerous, right? I would say, it's basically an attempt to kind of capture demand through like regulatory capture, right? Like just trying to meme a narrative into existence that says, you need to follow all of these rules that only we can follow, in order basically to give yourself a leg up against more decentralized protocols.
Okay, so if I had to sum everything up there, then rewinding the clock back up a couple of years, and I want to get your take on what the temperature is around just Lido and staking centralization in general, because I feel like at various times when Lido first launched, there was a positive push towards it because it was seen as a potential countervailing force to centralization from staking operators like Coinbase, right? There was this big concern that the exchanges were going to be just the largest stakers on networks like Ethereum. And then, because of the product market fit that Lido found when the merge, like pre-merge, when there was a beacon chain and a separate proof of work chain that was operating, and there was this huge gap in terms of when you staked your Ethereum and when you could actually get it out. Lido was eating a lot of market share, and then kind of some members from the Ethereum Foundation started to get a little bit worried about Lido, right? There was kind of like the Lido threat. And now it's interesting that there's a new segment moving into the market, which is a more institutional segment. There's obviously been a huge shift in terms of the regulatory regime in the US, and people are starting to ask, when are we going to get an Ethereum ETF that has staking, right? And then which LST are we ultimately going to end up using here? And so it seems like there was kind of the initial product market fit of stETH and Lido. Since then, there are new entrants that have moved into the market that have fragmented it quite a bit. There's an institutional segment, there's a restaking segment. So I think Lido's market share is down relative to where it was even a year ago. And then there's this interesting looming question of a more institutional presence within staking. So maybe we could actually start from the institutional side of things. And I would love to get your take. I mean, do you have any predictions or any thoughts on when we might actually get an ETH staking ETF? And then maybe we could talk a little bit more about what this institutional customer looks like in the world of staking.
Yeah, it's a very good question. So I don't have any inside track on like when a staking ETF is going to launch, but I think it's clear that it will, because it's just the better product, right? Like between holding ETH and holding staked ETH, like holding staked ETH is just it's basically that like higher yielding, like it's almost like very very low risk like yield on top of that, right? And so I think the line is probably going to blur anyway, because when you look at ETFs today, where you have this S&P 500 ETF, but under the hood it's also trying to generate some extra yield on those holdings that it has on the underlying, for example, by lending it to short sellers, right? That would be one thing that I think all of the physically held ETFs do, or most of them. And the reason is just that it allows them, by making a little bit extra yield on the back end, it allows them to lower their total expense ratio on the front end to customers, and thus get more inflows. And so all of the ETFs actually compete on providing, like ETFs really, really compete on price, right? They really compete on like the cheapest fees that you can offer to users without putting them at risk. And so the ETFs themselves are very, very strongly incentivized to push for staking itself, because it just gives them an advantage, like something else to differentiate on and make more money. And so one thing to understand about these ETFs is the fund currencies are always in US dollar. So when you go, and you buy, an ETF with $1 million, then they go out and actually buy ETH, or like buy staked ETH to back that. And when you sell the ETF, they actually need to take back the shares, and then they need to sell the underlying in order to give you your US dollar back, right? And so what we are seeing here is when you have staking happening in an ETF, then the size of the door actually matters a lot, right? So if you don't use an LST, using regular ETH, then you have to unstake from the beacon chain every time, and depending on the size of the queue, it can take a sizable amount of time. And you need to satisfy these withdrawal requests as they come in. And so what do you end up doing? You end up staking a very low percentage of your overall ETH in the fund. And so what LSTs are doing for these ETFs is they increase the size of the door, so you can stake a higher amount of ETH from the fund, and thus generate more rewards and offer lower fees for your users. And so that is why I think LSTs and ETFs are actually a perfect match.
Okay, so I completely agree with that's a really interesting bit of nuance. We're jumping the gun a little bit on some of the later parts of the conversation where we get into the weeds, but could you describe, my memories, we did this liquid staking season about a year ago with Miles. By the way, if folks haven't listened to the episode that you and I did together, definitely go back and listen to that. I can link it in the show notes. But my memory is that based on the way that the staking router is constructed today, it makes it a little bit difficult from an institutional perspective to actually stake with an LST. And we're going to get into the GOOSE-2 write-up that you did, but I know there's a concern from your end. There's definitely some advantage that some of these more centralized custodied solutions have a little bit of a leg up in terms of winning the market for an ETH staking ETF. So can you just describe for listeners so they have a little bit of the understanding of what the staking router actually is in its current construction today? Why is that maybe not ideal from an institutional setup, and how could that change going to the future?
Right. So the staking setup, the staking router, when ETH is coming in and it's sitting in the buffer, then basically what the staking router is doing, it's saying, where should this ETH be staked, with what module? Okay, so the staking router, the way that it works, when there is money coming in by someone staking with Lido, then the staking router decides where that money is going to. And right now there are 3 of these so-called modules in Lido. So there is the curated set, which is the OG set that Lido launched with. These are all basically permissioned professional node operators. Then you have the DVT module. And so that's a module that uses this new distributed validator technology that basically allows you to split a validator across many parties and operate it like a multisig. So that one is I think this one's going to become like table stakes in the future, as in this technology just allows you to really reduce the slashing risk and improve kind of the operating performance of your validators. And then the third one is the community staking module. And so if you if you remember Rocket Pool, and I think in the beginning we were talking a lot about Lido versus Rocket Pool, Lido being kind of the more scalable permission node operator set LST, and then Rocket Pool being the more permissionless one, where you were node operators had to post a bond, then they can get basically delegation on top of that bond to run more than one node validator, right? And so what the DVT is doing, it's doing our spin on it that in our mind is improving on some of the problems that other staking systems like that had, permissionless staking systems. And you can already today you can see that I think it's at 1% or 0.5%, and it was just voted to increase it to 2 or 2.5%. And so the idea is just that you anyone can become a node operator in Lido, right? So as long as you have some bond of ETH yourself, and we don't care where you get that from, right? You can borrow it from someone. As long as you have some ETH yourself, you can get really high leverage on that by getting more ETH delegated from Lido. You don't need to hold any extra tokens. You only need ETH. You don't need to hold any LDO or any other token. And right now, the participants in the DVT set, I think making 6 to 7% on their stake. Right, so the regular staking percentage, the staking API, I think is 2.5%. So they're making more than twice that because of all the extra ETH that they're getting, and they're also enjoying all of the benefits of reward smoothing and MEV smoothing from really their rewards being paid out of a much bigger set of operators rather than only building a blocks maybe every once every couple of weeks or months, or depending on how big your setup is. So anyway, so that staking router is the thing that connects all of these modules together. And similarly also on when someone is withdrawing, then the staking router would say, okay, who do we need to request a withdrawal from, which which of these modules, right? And so basically the staking router can be programmed to be opinionated about what the node operator set should look like. Like right now, there is a strategic imperative to increase the size of the DVT set because it's making Lido and Ethereum more decentralized. And so when there's a withdrawal, it would come from the curated set. And if there's a deposit, it would go to the DVT set, right? And so not the DVT, the CSM. And so yeah, that's how that works today. Sorry, I forgot like where you were going.
The original question was the institutional angle here. And by the way, just as a point of clarification for the audience here, I think also the reward smoothing that you were talking about this is one of the benefits of pooling stake. So if you are a solo staker or something like that, the chance that you get, you know, some big like MEV you know, execution layer reward is very low. But when you combine that with a bunch of other stakers and you kind of average it out and divvy it up to everyone, then on average everyone sort of ends up winning, which is part of the incentive to run staking pools in general. So just make sure the audience understands that. But the reason I think this intersects with, and this is kind of my question to you, and I only hazily remember this, is that from an institutional perspective, there's an imperative to know who the validator that you're staking to is. And the way the staking router works today, right, is some amount of ETH comes in. There's like almost a higher level allocation, which is this percent goes to the whitelisted module, this percent goes to the DVT module, the community module, etc. And then it just, based on some sort of you know, predetermined set of rules, it just gets divvied up to the whitelisted set, right? And so you don't necessarily know from an institutional perspective which specific validator you're actually staking to, which could be problematic. And that's also why, you know, I think there was a concern from your perspective in GOOSE-2 that some of these more centralized setups might actually win the institutional audience. Am I remembering that correctly?
Yeah, you are. Yeah. So even in the original Goose, there was a proposal that was called BYOV, which stood for Bring Your Own Validator. So the idea that like you can, you know, you can stake with Lido, and you can, you know, decide who you want your validator to be. Though I would say, I think like we would see there's a lot of connection between Lido v3 and this original idea behind the BYOV. But at the same time, I think staked ETH as it exists today is already a perfectly fine product for institutions, and we are getting a lot of validation on that. So I think it's always like important to separate a bit of like what is fact and what is fiction, because there are so many incentives to basically like create a narrative, for example, that like, oh, you need to know who your validator is, like your validator must be KYC'd, right? And if that actually catches on, I think it's terrible for Ethereum, right? Because then you know there's going to be so much ETH staked from the US, and the EU is probably not going to be very far behind in terms of regulation. And then having all that behind like a KYC wall, I think that would be really, really bad, I think, for Ethereum. And so fortunately, that's not actually what we are seeing. And so the estimates that I have seen is that 25% of staked ETH users are actually already institutions. So so you have crypto funds, obviously. You have now increasingly structured products that are being issued on top of staked ETH, especially in Europe. You have regulated banks that use it, and you know, because Lido is now supported by at least one qualified custodian, and so you know all of these have basically done their own risk analysis, like their own legal analysis, and said, you know, staked ETH is perfectly fine as it is. That's why we feel like very comfortable using it. And what I think what we are seeing instead is that what matters way more is having the best liquidity and having the lowest counterparty risk. And yeah, that is exactly where I think like a decentralized LST can shine.
So I'm going to give a little bit of a shameless self-shill here, but Blockworks actually did Blockworks Research did a survey of institutional stakers. So it was unlocked by Obon, the Liquid Collective, but also supported by our mutual friends at Steakhouse. So shout out Steakhouse. But I'll link it in the show notes, and you can go, and it's unlocked and you can go and peruse. But yeah, we basically just surveyed a bunch of institutional stakers and found exactly what you just described: liquidity, counterparty risk as being big drivers for where institutions are deciding where to stake. I want to make sure I want to get into this last point on the broader LST and sort of Ethereum ecosystem scape before we get into GOOSE-2. And one of the last thing that you outlined in GOOSE-2 here as a big environmental factor which has changed for Lido is this kind of issuance debate that's gone on. And I don't want to get too far into the weeds on it. You and John did a really great episode on Uncommon Core with Ansgar and Casper on this. We talked about it on this show many times. I've personally hosted a couple of debates on this, but basically there's this big debate around the Ethereum issuance endgame, and should we cap stake and kind of ETH moneyness versus stETH and all of that type of thing. And so could you just give a really quick overview? We'll link some of the other episodes in the show notes so people can go deeper if they're unfamiliar with this. But can you just give a quick overview of that debate? And then honestly, who is winning? Where are we shaking out here? What are the ultimate timelines? Like, when are we going to hear a decision? What's the state of this big debate that we've been hearing about for over a year now?
Yeah, it's a good question. I think the ETH issuance debate basically is about like, what should Ethereum's issuance be, and are any changes needed to it? Like, are we on a good track or are we on a bad track? I think that's roughly like the motivating questions for this. When you look right now, 25% ETH is staked, and like at the time when Ethereum's issuance policy was set, like 2 years before the merge, folks were very concerned about like, how do we even get people to stake at all? Are even enough people going to stake in order to basically like secure the network? And it was a different time. I think people outside of the protocol design were having like a more realistic take on this. I think like it was also like, with LSTs, it was the same thing, right? Like the fact that you had the beacon chain launch more than a year before the merge, and it was forcing people to lock up their stake. Many have warned about that this would create a huge incentive basically for people to stake through exchanges, like centralized exchanges, right? And they would soak up a ton of ETH, and this, like, you basically giving a free handout to centralized exchanges, because they can hold the validators on their balance sheet and still allow users to trade with it and to collateralize it, etc. And I think that was like a huge blunder that, like, we'll have to say, fortunately, didn't end up hurting Ethereum very much. And it was, I would still insist it was due to, like, in large part due to Lido, I think, creating a decentralized alternative at this time, that I think a disaster for Ethereum was prevented. But back to the issuance debate. So I think there is, the same way that, for example, like Georgios and I thought that, there would be more like smooth sailing in terms of like LST is the most dominant form of staking, the best form of staking, and like would crowd out other forms eventually. I think that this argument was quite convincing to a lot of Ethereum researchers as well, and they started to see both like high staking rates as a problem in general, because it creates this additional dependency for the Ethereum network and ETH the asset, and also like particular, I think, LSTs within that context. That like if one entity like was to handle a lot of the staking for Ethereum, and that can create additional centralization risk. I think on the other side of the debate, you have more, you have, I think, more like industry folks, I think, from the staking industry who are very familiar, I think, with like the incentives and the cost structure. And like, interestingly, they will tell you the opposite, right? Like, whereas maybe the proponents of issuance change will tell you, if we don't lower the issuance and like cap it somewhere, then the staking outcome will be very centralized. And the industry people will more tell you, no, if you if you like cap it too low, then the outcome will be very centralized. And their argument is that when you cap staking very low, then basically you will like really magnify the competition on price, make like a really small staking market. And it's and then the more centralized, lower cost providers will really crowd out the more decentralized providers, and it would be a very bad outcome for the validator set. And I think it's very hard. Like, I see myself as more in the middle of this debate. So I'm neither like very strongly pro nor against doing it. I think because I see myself in the middle, that's why I'm, it's interesting because like I don't really care if it's changed or not. But because I don't care, I have to argue against it, because I think things like in public blockchains, like these kind of big controversial changes should be very rare. So I wouldn't be mad if it happened, but I think the fact that it's not like, it doesn't seem like a very important thing or very like good thing or clear thing to do, that makes me want to not do it, because I think it's just, creates a lot of like unnecessary friction. And a lot of people have pointed out that it's, I think when John, and we can talk about this because it's a super interesting topic, but the idea that like when people like Max Resnick and John and others were putting this Ethereum North Star debate, they were making this very popular. I think a lot of people started to make the connection to issuance, which is why do we keep going in circles about issuance? And you have basically industry people asking, so what are you trying to achieve? And some EF researchers, asking, okay, like, why don't we try this curve? And like, okay, but what's the goal? Like, what are you trying to achieve? Because if we can agree on the goals, then we can have a better debate about how to get there. And I think people started to connect this to this Ethereum North Star debate more, and they started to realize, hey, we don't really know where we are going with Ethereum. And when we talk about issuance changes, are we doing this for the asset? Are we doing this for the network? Because these things, they would have very different implications, like one way or the other.
Yeah, there's, that's such an interesting debate, and I know there've been a lot of podcasts and debate on Twitter and back and forth. And I want to end the episode in diving a little bit deeper into this with you. There was so I was actually there at DevCon when Justin Drake gave his talk about Beam Chain, and I took a photo of it. I'm not gonna be able to find out because it's on my phone, but there was where he sort of outlined the priorities of Ethereum. Right. And it was super interesting because, he kind of did P0, P1, P2 across 3 different categories. And at the bottom of each of those categories were, I just remember at the top of one of the categories was adjusting the issuance policy. And at the bottom was single slot finality, or just not even single slot finality. It was just, decreasing time to finality. And it was the same thing for, one of the other P2s was, going to 4-second block times as opposed to 12. Right. And, I remember everyone was all up in arms about the 5-year timeline, which is actually a 4-year timeline and whatever. Okay, that's long, but I don't actually think it was about the timeline, at least from my perspective. It was, the reason I would trace it back to this North Star debate is I think people would have been fine with a longer timeline if the priorities had just been flipped almost. And I know everyone wouldn't necessarily agree with that, but that's why I think there's this North Star debate that's raging, because people aren't really debating the same thing. It feels a lot like ships passing in the night, which is in a debate extremely frustrating, which is why I think everyone's frustrated. But Hasu, give me your sense on, on this issuance policy, because this is something that's been talked about quite a bit. Where are, like, if you had to guess, which side do you ultimately see winning this debate? And then when do you think we get a resolution here, one way or the other?
Yeah, I think first of all, I completely agree. Like, it's very weird to see these things up there without having like some kind of debate about, well, what is the goal? And so I'm very happy, like very thankful. Like, some people realize this and were, like someone like John is like taking the time to write this up and basically verbalizing what a lot of people may be feeling like subconsciously. They're like, why does it feel like the other side is not listening to me? Right. This feeling. Yeah. And it's because we don't have the common ground established that you need to have an actual like productive debate about something, right? Like, we have different goals, and so we're each proposing different initiatives, different changes to Ethereum, that like they are going in different directions. And then how do you even compare these things, right? How do you decide what goes into the next hard fork, or what we should prioritize on a 1-year timeline or like a 3-year timeline? It's not possible, right? It becomes basically like a beauty contest. And I think people have this feeling that, ETH governance can be a bit of a beauty contest. And it's because, you lack basically like the comparability of proposals, because there's no common dimension to compare them on. And so do I think that an issues change is going to happen? I think it's very hard to say. I think I'm more leaning no, because in order to make such a big change, you need a lot of activation energy.
Yeah.
And it doesn't look like that energy is there. Like there are folks who are very in favor, but they all work at the Ethereum Foundation. Like not everyone at the Ethereum Foundation is in favor of changing the issuance, but pretty much everybody who is in favor is working at the Ethereum Foundation. And I think the community reception has not been good. Not maybe, it's like, I don't oppose the change on the basis that it's a bad change, but it's just not maybe the right priority. And I really like more, I think, the energy that we have been seeing the last couple of weeks about, there was a really good presentation on, what are the low-hanging fruits to improve Ethereum's execution layer, for example, right? And I think that is what I really love to see. It's the idea of like, a lot of these changes, like you should basically be able to trace them back to how does this improve user outcomes, right? And I get it that Ethereum is very like gung-ho about solo staking. Solo staking is very important to protect Ethereum's censorship resistance. But solo stakers are not the main users of Ethereum, right? It's one stakeholder basically that you need to manage. But like most of the things that Ethereum is working on, there should be, you should be able to trace them back to like very real things that improve like on the ground for users of Ethereum and application developers on Ethereum. And I think in these two areas, we have seen just way too little thinking about what these groups want, and how we can make their life better on ETH layer 1, right? And I think that's there's an opportunity here, right? So Konstantin Lomashuk, one of the founders of Lido and founder of Cyberfund, he has been tweeting a lot recently, which I love to see. But one of his tweets was, maybe there's room for a second Ethereum foundation, and this foundation actually is like more application focused, right? Because there is a lot that you can learn from what actually are the main use cases on Ethereum that people want to use, and what do those apps need, like almost like an all-core devs call, but for the application layer. And I think that's a fantastic idea, right? Like I just to source these ideas and like put them on the table and like make people feel heard and like talk to them and understand what they need. And I think there is a really growing understanding that like 95% of TVL on Ethereum and like 99% of the transaction activity is actually related to DeFi in some shape or form. And like this is really the killer use case, right? Which is something that I think maybe Ethereum leadership has been a little bit like head in the sand kind of vibes about, right? As in, like, this is not maybe the kind of use case that we want. Although even I don't disagree with that at all, because I think there's very few ways to like make the world better than by strengthening property rights and like improve the way for people to trade and engage in like, trustless cooperation, at this kind of value layer. So I think DeFi is extremely world changing. And John was saying in some other podcast the other day, but I remembered the quote because I really agreed with it, just that somebody I think was asking like, why has DeFi like become so boring or something like that? And he's like, what's boring about it? Like there's only, there may only be like a few kind of primitives, and you don't like invent a new primitive every year, right? There's only like so many primitives that exist outside of DeFi in TradFi and so on, and just the way that like the economy works. But there's so much room to make these better, and like, you know, they are each one of their own is like $1 trillion value, like $1 trillion outcomes, right? And there's so much here to like improve and refine and master on like so many dimensions. I feel like this is more the mindset that people should have. You know, like people see Uniswap, and Uniswap is like on top of the like DEX leaderboard for a long time, and somehow they think, you know, you can't disrupt Uniswap. Like, you know, like DEX trading is done. Like, what is there to improve? And there's so many things to improve, right? And then they're surprised, and like, you know, 2 years later, Uniswap is releasing like, you know, a new version, and it's making like very big improvements. And like, okay, why was this not invented by someone else, right? So I think people have, I think it's a mindset problem in a lot of ways.
So, okay, I was going to talk about this with you at the end, but now you brought up a bunch of questions that I have. So, okay, where do you think, you know, so we just talked about activation energy for the issuance debate, and your take would be probably not, right? Because there's some amount of natural inertia that happens, and it's just very difficult to overcome. Where do you see this whole Ethereum North Star debate shaking out? And, you know, if I had to broadly categorize the two sides, there is the, you know, John Charbonneau and maybe Max Resnick, not 100% aligned, but I think the perspective there is to basically move some amount of activity back to L1. And maybe we could even say, like, I've been thinking a lot about how much really of the pie here is actually DeFi, and especially like how much high margin fees does DeFi generate relative to other categories? I think is an interesting debate to unpack as well. But there's kind of this push to, I think John's perspective would be just make some advancements to, you know, credibly signal that you're interested in scaling the L1, which is also beneficial to L2s. So there's this new pump the gas way that validators can signal that they want a higher gas limit. We're trying to go to 36 million Gwei right now from 30 million. And just credibly signal that we want shorter block times overall. We're not going to go to 2-second block times overnight, but just say go down to 8 seconds or something like that. Maybe. And then the other perspective is we should almost go the other way. And actually, I think there actually are still people that have this perspective of wanting to elongate Ethereum's block times and actually make it even more difficult to do transactions on the L1 to incentivize people to move to layer 2s. Where do you see this ultimate debate getting shaken out? Like, where do you think we end up in a year or two?
Right. Okay. Well, I have a few. I think I feel pretty confident here.
Okay.
In my takes. So I think layer 2s benefit tremendously from having a strong layer 1. Like, you would not be launching your layer 2 on Ethereum if there weren't a ton of assets on ETH layer 1. That you can get through the trustless bridge, right? Like, there's no reason to make a validating bridge to Ethereum if you can't tap in like Ethereum's user base and like Ethereum's TVL. It's just like nobody cares otherwise, right? So it's those two things that people really want. And so, first of all, like, the layer 2s should be heavily incentivized for the layer 1 to improve, because the layer 1 is in a lot of ways the source of a lot of their activity. And this may change, right? So I think it would be interesting. I haven't actually seen the numbers, like how much of the assets is like coming from ETH layer 1 versus it's maybe natively issued on layer 2 plus, like, you know, related activity. Someone should look into that. I think that would be very interesting. So that said, like, I'm a DeFi user, and I'm using the Ethereum layer 1 like most of the time. I'm not really using ETH layer 2 very much. Why? Because it's not like, for the amounts of money that I'm using for the transactions that I'm making, layer 2 is not secure enough. It's not liquid enough. Like, it's those two things, right? So, and they are very related, right? Like, ETH layer 1 has this like insane like security and lindiness from it. And for me, it doesn't matter that my block time, you know, is maybe 1 second instead of 12 seconds. Like, 12 seconds feels plenty fine when you're like, I don't know, making a trade or borrowing money or something like that, right? Or just moving assets between like different yield opportunities and so on. Okay, so yeah, I just see no alternative to ETH layer 1. And I think a lot of people think very similar, right? So I think high value DeFi has had a very tough time, honestly, like getting to layer 2, right? And I think you see very little of this moving from the layer 1 to the layer 2 because of these demands that users have about the security of the chain. I think most of the TVL or the DeFi activity and the DeFi TVL that the layer 2s are capturing are like net new activities that were not actually possible on the layer 1. And so, I mean, if you look at, I don't know, exchanges, I mean, what was the exchange, the perp exchange that did really well on Arbitrum before there was Hyperliquid?
GMX.
GMX, yeah, exactly. So I mean, there was GMX, and I mean I think that kind of LP strategy couldn't really work on ETH layer 1. And then you had Hyperliquid, and like I mean, I think you have these breakout use cases that I think really strongly require you to customize more of your stack, have faster block time, and those things. And then you have like net new use cases. I think Base in particular, you have the meme coin trading, which, yeah, like UX matters a lot here. Balances are really small. So, and like cost matters, right? Like this kind of, speed, cost, and not a very high security demand. So it's very perfect to do it on Base. And then the AI use cases, I think, like similar-ish, right? So I think a division of labor like that is actually very perfect. I think like for Ethereum to handle like the high value use cases, and then for layer 2s to have like a mix of like DeFi that is net new, that is only made possible through much lower cost and or much better UX, plus like these very like net new activities that are most of them pretty like UX/cost sensitive because they are all targeting a more retail-y audience. So I think that's great, but it would be long-term more difficult for these layer 2s if Ethereum layer 1 wasn't improving in lockstep and was also doing stuff to like attract more TVL and more usage to the ecosystem. Then you would see way more chains just straight up like make their own layer 1s or maybe go to, I don't know, make a Justice Bridge somewhere else, I think. And yeah, I mean, how can Ethereum layer 1 do that? I think, I mean, a proposal to increase block time in my mind is pretty crazy. Like, I would not support that. It's like, I don't know, like, I mean, like, why did we want that? I mean, I think the main reason here was like, if you increase the block time, well, you can finalize the blocks faster. Like, you can like arrange the like duties in like a somewhat different way. But that's not something. If we go back to like, tell me how your proposal improves real user outcomes, it's not even on the chart. Like, I don't know how it improves that, right? But it would make the chain less usable. So that's clear, right? Like, I think with latency, the thing is, if you make latency too high, the chain becomes very unusable, and then it doesn't matter that it's maybe more decentralized or something. If you make it extremely low, then yeah, the system, you will not be able to decentralize it. And so there's a sweet spot here where you want the chain to be fast enough so that it can be a good user experience, but not so fast that it becomes very, very geographically centralizing, because all the things are happening so fast that there's this very big advantage to co-location. But I mean, definitely we have a lot of empirical data from MEV that like 12 seconds, like you can go much faster. Like you could probably increase, like you could lower the block time to something like 4 seconds and probably still do all other things that we're doing right now in 12 seconds just by arranging them in a different order. So yeah, I'm pretty optimistic that over the course of maybe 3 to 4 years, like a change like that would be possible if the political will, I would say, is there.
Okay, so
I mean,
if I had to sum up,
Oh no, go ahead.
So if I had to sum up, basically your perspective here is you think there's going to be some incremental amount of scaling on the L1, which is going to improve the environment for L2s in general, and that would be potentially shorter block times, but also I might be paraphrasing or editorializing a little bit myself here, but a shorter time to finality. And that's going to leave some amount of DeFi activity on the L1. And then maybe some of it sounds like you view it as almost two different customer segments, where there's kind of like the high value use cases that stay on DeFi L1, and then maybe lower latency or just like lower amount sort of trading moves up to L2s in general. Is that a rough summary?
Yeah, absolutely. Yeah. And I think there's more you can do, right? It's not just about speed. I think there's plenty of low-hanging improvements for the layer 1 that you can do. Like there's a lot around the account model, like the way that transactions work. I mean, to me, it's crazy that in EIP 1559, it's still not possible for the block builder to pay the base fee for the entire block. It's like such a low-hanging fruit change. It's like it would make gas sponsoring so easy for folks. Like you don't no longer need gas, like even your account and stuff. And sometimes I wonder if we are making more friction in the UX deliberately, because some people want to maybe boost ETH the asset. Like, we want people to hold ETH and use it for fees and so on. Like I don't think it's a motivation for many people, but maybe some. So like I think, and this is like, you understand these if you just talk to application developers, like what challenges do they have, and to users, like what are the things that they struggle with on Ethereum, and you'll hear a lot about like UX issues. I think smart accounts are very expensive to use on Ethereum layer 1. And they have some drawbacks, like people want to keep using EOAs, but there's a lot of things you can't do with EOAs. So if you can make EOAs more programmable and give them some of the benefits of smart accounts, I think that's another area, right? I think I think these would be two low-hanging fruits that I think we can realistically do in maybe less than 2 years.
Okay, Hasu, I've got a follow-up question for you here, and then I want to return back to liquid staking and GOOSE-2 because we've wandered a little bit, but this is just very interesting. So I just want to keep getting your opinion here. So I actually wanted to, what do you, so my understanding of the trade-off here and why this makes sense from a roll-up centric roadmap standpoint is that Ethereum is comfortable foregoing some of the execution sort of fee, like ordering fees, right? That's going to happen at the L2 layer. And in exchange, what Ethereum, the network, but more so ETH, the asset, gets for that is more people on the layer 2s where there's, theoretically net new activity that wouldn't be occurring before are using ETH. And so ETH, the asset, gets some sort of monetary premium, liquidity, network effect, whatever you want to call it. And so, my question to you is, do you think that that's ultimately going to play out and come to fruition? And, you were just sort of, I actually thought it'd be interesting to walk through. So this is from L2 Beat, and we're looking at Arbitrum here. So Arbitrum 1, the in-chain, and you can actually see for natively minted value. So probably think about this as kind of net new value and exclude ARB here, right? Probably just look at USDC.
Right.
But there's far more USDC that's being natively minted here on Arbitrum than anything else. And then there's a funny amount of externally bridged value, which this is kind of Arbitrum specific. And most other rollups, it's not this high. And then the canonically bridged, as you would imagine, it's mostly ETH. But if you look at the amount of ETH, which has been bridged up from main chain, it's 3.5 billion versus, it's almost actually
how does
exactly
this work
the same.
though? I wonder if we're like counting this correctly, in the sense that like if I bridge USDC from ETH to Arbitrum, is it gonna be only counted in like the externally bridged, or is it actually is there like a message sent to USDC that destroys the USDC on Ethereum and just natively mints it on Arbitrum? I think that's probably the case, right? Like how else does like 5 billion of like USDC get to Arbitrum? Like by what flow? What is the user flow here?
Yeah, I'm not 100% sure either.
I think way more value is externally bridged than I think what this chart is implying.
Okay. Well, either way, I mean, I'm curious. I think the point still stands in general, and this is something that actually, like Cosmos, is a great example of maybe an ecosystem that ignored path dependency and really tried to skip to the end, and I think got a lot of stuff right about the end game. And one of the things that they had a strong philosophy on from day one, and maybe it's not even a philosophy, it's just a very different sense of who their customer is they leaned into USDC and stablecoins from day one, right? So they had no lock-in for Atom or anything like that. They just allowed, they had the perspective of, hey, we're app developers. We want to meet our customers and users where they're at, and our customers and users mostly hold dollars, not Atom. And so we want to satisfy them. And I would guess it's a similar incentive for L2s as well, especially, I'm showing Arbitrum here, but this would be heightened on a chain like Base, where obviously Coinbase has a large profit incentive around USDC. And so I'm sure they're going to make the UX for USDC much easier on that chain in general. So how do you think about that kind of trade-off? Like if we had to zoom 5 years into the future and you had to guess the amount of USDC or even, things like BIDL, tokenized treasuries that are held on L2s versus ETH, how do you think that shakes out?
Yeah, I mean, I think that the more you move from layer 1 to layer 2, I think the more you want to think in this application mindset that you're describing, right? And I think forcing people to hold some kind of token that they don't want to hold, I think that's crazy from a UX perspective. Like in the future, people won't care about, I mean, we keep reiterating this, maybe it's like we're on like year 3 where I say this on a podcast, but at some point apps, like users will only interact with apps and they don't even know, what blockchain they're using under the hood, and they won't care. They have a job to be done and the app is doing the job for them. And, if you make the job more complicated than necessary, I'm going to go to your competitor. So, yeah, I mean, so of course, like people want to hold stablecoins. Like, I mean, most of us hold, I mean, we don't really have like like we in our main account or spending account, like we have dollars or euros or whatever. And then maybe we have like a crypto portfolio that we manage, right? But spending that is, can be more tricky, right? You always have to think about taxes and whatever. And I think that's probably not going to change. So yeah, there is a less friction, I think, involved with like stablecoins. And I mean, at the beginning of your question, you said something very interesting, which is that like ETH is giving up some kind of fees from these apps like happening on layer 2. And I think that's actually the wrong mindset, because ETH is not giving up anything. Like these transactions are only happening, many of them are only happening because they're on layer 2. And they are on layer 2 and they are packaged and they are posted as blobs to Ethereum layer 1. And like, this is like I mean, I see them as use cases that Ethereum can only satisfy in the form of blobs, but not in the form of blocks, if that makes sense. So like you need, like layer 2s are basically repackaging Ethereum layer 1 block space. They're repackaging it in a way that opens up net new use cases. And if it wasn't a net new use case, like if it wasn't differentiated from Ethereum, people wouldn't use it, right? Because these chains have a lot of security overhang. They have less liquidity. It requires people to switch their chains and like chain ID, and like, it is still a very cumbersome experience, right? If I didn't have a strong reason to go to layer 2, I wouldn't do it.
So I agree with that, but let me push back on your pushback a little bit, because I think that Ethereum isn't there are, even though you might be creating net new use cases, like those users that are generating fees up on Base or Arbitrum wouldn't be using Ethereum anyway. That is true, potentially. Although what you've now introduced as well in this ultimate, like the fees that get generated, between the L2 and the L1, is you've introduced a new set of actors that need to take a cut. And I guess one thing that I've been curious about in general is, which part of the supply chain is going to get to extract more fees.
Right.
And I think that that's why I sort of think the ordering, whoever gets to do the ordering, ultimately, I think there might be a little bit more value there, as opposed to maybe the value that Ethereum gets to extract right now is kind of like at the base of that layer, which is the kind of like the settlement DA part of that. If it gets DA and are competing with the Celestios of the world. And ultimately, I don't know, there's a strong case that maybe that doesn't actually ultimately end up mattering. I think I might place a little bit more emphasis, because I have this perspective that yield is going to ultimately be very important in terms of the L1 value proposition on a really long 10 to 20 year time horizon. I think people are going to look mostly at L1s as almost the equivalent of treasuries or sovereign bonds, as being, okay, it's this deep, very liquid asset. There's some small amount of yield on top that looks kind of like a coupon. Maybe I get a little bit of capital appreciation. Maybe it's just yield. whatever it is. And so maybe I realized that I might be weighting that a little bit more, but that's why I think it's just interesting to try to guess at where the value gets extracted. And I do just last closing point. Sorry, I know I'm monologuing here, but I've noticed there's been a little bit of a subtle shift, I think, in terms of how the rollup centric roadmap has gotten framed, which is that I would be a little bit more sympathetic to this if after we introduced blobs and layer twos, the net amount of fees that were being generated for Ethereum was higher, right? Like that would be a win-win for everyone, which would be, all right, we've got all these layer twos, there's this new market for blobs, but the total amount of fees that are being generated for Ethereum are higher than what it used to be, but the fees per transaction are much lower. But that's not really what we're seeing in practice today. So sorry, that was a bit of a ramble, but that would be my pushback on your pushback.
Yeah, I mean, where is the value going to be extracted? I mean, it might sound like a joke, but I hope on the user layer, right? I hope that crypto will have a lot of thin layers, and most of the value will go to the user, be extracted by the user in the form of like more value, new products that didn't exist before. I mean, that said, I think good framework is obviously like which layer is the hardest to replace, like which is the hardest to switch between. I think ultimately the apps are going to capture most of the value. Like I have very little doubt about that. I think some absolutely gigantic businesses will be built on top of crypto. Some may already exist. Some might, yet to be built. And then the infrastructure, it's honestly hard to say. I think both for the different jobs to be done, right? Like sequencing data, proving consensus, and like what type of bundling will prove to be optimal. Like I'm leaning in the direction that there different apps will favor very different combinations of those things, or different permutations of those things. And like we've yet to see, what are the dominant apps going to be, and like what do they most benefit from? Like what is kind of the optimal solution for them? And I mean, I think without really looking at the apps that have a lot of traction and looking at like their value chain, like how they create that value for the user, I think it's harder to make predictions about like how does the value chain that actually satisfies that use case, how will that evolve? So I'm constantly looking at how that's changing, and I think it's very interesting. But yeah, I think it's in some ways like too early to say. And yeah, I think the one thing that I do know is that like you want to own the apps.
I agree. Yeah, completely agree. It's definitely too early. And Sam Hart came on this podcast about a year ago and said something which has always resonated with me, which is it's always interesting to try to guess at where value gets created and extracted, but ultimately we're still in the building phase here, and that's a little bit of a luxury debate to even have, which there's so much that we're still trying to get to just work. I will say though that I did an episode of Expansion actually with Terry from the Eclipse team, who laid out pretty succinctly what I thought it was interesting the way that he was thinking about this, which is he's also on your page that the apps are going to extract most of the value, and that's going to end up being this like ordering at the ordering layer. And then if you look at L2s today, they have three sources of revenue, or three buckets of revenue. The way they generate, there's a kind of a priority fee layer, which is basically ordering. Then there's congestion, which is what's the amount of compute that users are demanding versus the amount of compute that can get used. So there's a congestion fee. And then there's an L1 pass-through. And L1 pass-through is like the least, it's revenue, but the margin is 0%. It's literally a pass-through cost of what the L1 is charging. Then there's the congestion layer, and then there's the ordering layer. And his perspective was that apps are largely going to take the ordering layer there, and then the congestion layer is going to be left for L2s, which is, I don't know, I hadn't heard someone articulate it like that. Still just a guess framework on a long-term time horizon. But
yeah, I mean, I wouldn't work at Flashbots if I didn't think that the ordering of transactions was going to be a very important job for different parts of the stack. So yeah, I obviously do believe that there is. I mean, it's both good and bad, right? It's bad in the sense that there are a lot of economies to scale. And network effects in ordering. And I mean, we have seen only some of them so far. play out, but there will be more that will kind of show ahead in the future. And it's good if you can build something decentralized here. There's a potential like $1 trillion protocol or network or something, I think, to be created here, right? And I think that's at least why I'm personally very interested in this problem, because I think it's one of the biggest problems that exist.
All right, everyone, listen up. Like I said at the top of the episode, Uniswap Labs is rolling out the red carpet and launching a $15.5 million bug bounty. This is the largest bug bounty in the entire history of crypto to anyone that can find a critical bug with the Uniswap v4 protocol. This bug bounty aims to make it the most rigorously reviewed codebase ever deployed to Ethereum. Now, the Uniswap name is basically synonymous with security. $2.4 trillion in cumulative volume has passed through Uniswap v2 and v3 without a single hack. So Uniswap v4 is dedicated to bringing that same level of security and transparency to the v4 protocol. So if you want more information or eligibility or scope or rewards or payout or any of that good stuff, there's a link in the bottom of the show notes. I highly recommend that you stop listening right now, go to the show notes, click the link, head over and tell them that I sent you. Start earning money today. All right. Should we get into this? Yes. Has been very interesting. Let's get into GOOSE-2 here. So all right, Hasu, this has been great. I want to refocus us a little bit and move back onto the original purpose of this podcast, which is to discuss GOOSE-2. So can you just give us an overview, really quick, actually, of Goose in general? What is that within the context of Lido? Give us a quick overview of the first iteration of Goose, and then let's spend most of our time here discussing GOOSE-2.
Yeah, it's interesting that we talked about Ethereum's North Star debate. So the idea is not to have, it's how to frame this. I think, there's a bit of a context in Goose, which is, I've been for a very long time, I think one of the biggest skeptics on DAOs and decentralized governance. And it's like saying how it's very hard to make decisions in a group and like execute efficiently, and that DAOs will just be outcompeted by like more lean and kind of streamlined organizations. And I think Goose is the idea of basically threading the needle between the decentralization and kind of having a streamlined direction that everybody can follow. And so it's a process that's currently once per year that basically determines what and why the Lido core contributors should work on or should work towards, right? And so it's laying out a general direction, and then the contributors can go and kind of determine how they want to do that with their much better kind of experience and like local knowledge about the market, right? And Lido has basically a vision and mission statement that is enshrined in the DAO. And so it's Lido's purpose is to keep Ethereum, and I'm reading this out. Lido's purpose is to keep Ethereum decentralized, accessible to all, and resistant to censorship. And its mission is to make staking simple, secure, and decentralized. To create a world in which Ethereum is the coordination and value layer of the internet. No. But like, okay, if that's the goal, like how do you actually get there, right? And in the very first Goose, the idea was basically, okay, let's focus on stETH. Let's focus on making stETH as the singular product that we talked about in the beginning. That was like, I think, like in our mind, like the right thing for like a very large amount of the market. Let's focus very singularly on that, but let's make it as decentralized as possible. And so this decentralization was, to kind of reflect it across multiple different dimensions. So there was the governance, removing as much governance as possible from the Lido protocol, like really removing like the elements that the Lido DAO actually needs to govern, but also the node operator set. So like how are like new node operators added to the set, and is it possible to permissionlessly participate here, and like how are they distributed around the world and across different setups and all of those things. So like the decentralized node operator set, decentralized governance, and and make stETH as good and as widely used as possible. I would say then about a year later, we kind of can talk about, we in the beginning talked about the rise of restaking, kind of like increasing at this time, increasing fragmentation of the staking layer. And, what we did there was basically say, it is too late to launch like an LRT, and it would undermine the value proposition of stETH. And I think you can actually, the right play is still to stay an LST, but seek to become the number one collateral used in restaking. So staked ETH would play an important part in restaking, but not as a kind of top line asset, but rather as like a collateral that is then restaked. And it can be used, either to create LRTs or also like don't create LRTs, because not all of the restaking category is actually liquid. And we can talk about some of the intricacies of that later as well. But so now we are kind of getting to GOOSE-2. And in the beginning, I think we discussed a lot of like what led to this, which is basically like an increasing, I think it's, you can frame it in a bunch of different ways, right? So you could say it's a market saturation of the LST category, because Lido, like staked ETH, has a 90% market share in the LST category, right? It sounds extremely dominant, and it is. There's no better LST. But both, LRTs has gained prominence as a new category that didn't exist before, and the category size of the liquid category, so LST plus LRT, also has not grown, surprisingly, right? So like LRTs have eaten a little bit into LST market share, but the category itself, like liquid assets versus non-liquid assets, has not actually changed for over 2.5 years now, right? So basically some of the assumptions that we had about the market, like what the users want out of their staking setup, I think this is has basically proven to be wrong. And instead we're seeing like a fragmentation now across different setups, fueled by restaking, fueled in part by kind of more institutional market. And so what is needed is basically is a change in the strategy. And GOOSE-2 lays out basically three goals that map also to the three kind of value streams that exist in the Lido DAO, kind of the contributors. So one, on the node operator side of things, let me take a step back. On the staked ETH side of things, and this is really, I think, the biggest one, is the acknowledgement that just kind of staked ETH in itself is not enough to satisfy kind of this growing fragmented like demand that users have about what they want their staking setup to look like, right? And so it's the understanding that one product staking is not going to take us to the next stage here, and instead you want to create a kind of setup where you can have different staking products that satisfy different users and different use cases, but they all benefit from the same liquidity. They all benefit from the same underlying infrastructure and implementations and so on. And we can unpack that much more in a bit. On the node operator side of things, there's the idea to create a market for validators, and it's very synergistic with the first goal, because when you have different staking setups, then you basically want to have a very efficient way of distributing stake across these. And you also want to make sure that the way that the stake is distributed is both aligned with the goals that the Lido DAO has for what the node operator setup like should look like. For example, in terms of distribution and like what kind of setups is used, etc., but also on the cost, because we have already seen in the curated set, Lido is paying 5% to the node operators. I think in the CSM, it's paying around like 6 to 7%. Why? Because there is a different this type of setup is just more expensive to run for the operators because they have a higher operating cost, right? And so there's this kind of rising acknowledgement that different setups are have different costs to run, and some have also a lower cost to run than is maybe being compensated right now, right? So the idea that I think some of the more professional node operators also have a maybe there are some of them that have a much higher cost, but like the more professional ones, you could actually also pay less over time. And in the competition on price between different providers, like Lido must become more flexible as well. And then on the governance side of things, so there is the I would say the idea that there's a social contract here between there's like both a social contract and like an economic link between LDO, the token, and the way that I think the the protocol works and also how the governance works. And I think it's good to start exploring that a little bit more in 2025. So for example, LDO secures the governance in Lido DAO, like the ability to make good decisions in governance, to get quorums, to defend against governance attacks, and I think this it's kind of good to start activating more LDO and start kind of getting people more engaged. And I think when you are a DAO, then it's just like everything is already decided by LDO, right? When every single change to the protocol has to be passed by LDO holders. So whether it's through a snapshot for more off-chain related things, or it's through an Aragon vote for anything that is on-chain related, it's just the acknowledgement that I think the DAO is the LDO holders, right? And so I think it's you can strengthen here the social contract more to make to basically show that Lido is a project that is thinking very long term and that is very like worth spending like time and capital on and mindshare, and like we can together grow this into something that will be like really, really big and valuable in the future.
Okay, that was a really helpful overview there. I've got specific questions on each of those three prongs. So I like the way that you phrase this in GOOSE-2 of, let's focus on the stETH component there first, which is transitioning from a product to a product line for the staking ecosystem. So, and maybe this is where we can, I'm going to ask you to tease a little bit about, V3 that's coming up, but how my understanding of that is, we're trying to remedy here these new or some of the saturation of new customers coming in. So there's the restaking segment, there's the institutional segment. So what is the plan of attack for, as the liquid staking ecosystem has evolved from a very homogenous customer set to a much more heterogeneous customer set with different sets of needs? What is the plan for reaching out and grabbing the restaking segment, the institutional segment? You also talked about like the leverage seekers, the loopers, if you will.
Yeah. So the some of the restaking, of course, we're already addressing by becoming like making staked ETH much more used as a collateral in restaking. But kind of taking a step back, I think there's a few problems here, right? So that I think would be good to solve. And so the biggest one is probably that in Lido today, you have very low flexibility on the setup that's being used. So you cannot decide, if, for example, if your particular setup that you're using, if that's being restaked or if that's being looped, and there's always like ways to do this kind of out of protocol, but not really in the protocol itself. And when you do, like, you can you can create, let's say, an LRT, and you can also use like staked ETH under the hood, but then you lose the ability to like have liquidity on top and like have all of these integrations, right? Like you either you give up on the customizability or you give up on the liquidity, and you can't really have both right now at the same time. And the other problem is it is not that easy today for businesses and for other protocols to work with Lido. So let's say you have customers yourself, like you can drive, you have users, you have customers like that you can drive to staking, like you want to offer staking to them in what way, whatever way, right? Like using a customized setup. It is very, like, it's not possible effectively to do that today with Lido. Like you can negotiate a revenue share, which like a lot of projects have that. But then you are still bound to like this one setup that basically Lido offers today, right? Like you get like this one size fits all setup from it. And so what we can actually say is, and this is kind of getting to the new platform that Lido contributors are working on. It's called staking vaults. And so, yeah, the idea is to like you can use the Lido infrastructure for a highly personalized staking setup while also tapping into staked ETH liquidity and integrations. Like so, you can have your own setup, and then you can mint if you want to. You can mint staked ETH against it, but how much staked ETH you can mint basically depends on the setup that you're using. And so what this does is basically it evolves Lido into something that various types of organizations, like various types of parties, businesses, node operators, other protocols, custodians, banks can use to create entirely new stake-based products that can still benefit from staked ETH's liquidity under the hood. And I'll pause here for any questions.
So actually my what I found myself thinking about, when you were describing that is actually a little bit more of a question related to the node operator market that Lido is trying to curate. And so it's very interesting. So one of the things that I think Lido doesn't get enough credit for and deserves more credit for is actually being a potential. There's a lot of natural economic incentives for staking to be centralized, right?
Yeah.
And so what I think staking operators like Lido can actually do is be a countervailing force there to decentralize the overall staking of the network, and that's what you see in these different modules. So there's the whitelisted set, which is mostly institutional stakers, but then there's also the community set. There's DVT, and I'm very curious. You talked about in the GOOSE-2 write-up that you would programmatically reward different modules based on not only their like efficiency, but also potentially like a contribution to the decentralization of Ethereum, the network. And I'm curious how you would think about weighting that. And I actually, one of the things I was thinking about when you were describing the different cost structures of different stakers is it almost seems like there's a little bit of a funny incentive there as well, right? Because obviously the large institutional stakers that have economies of scale can stake for a lower rate. But then you're also, what's the incentive for them to continue to push down the cost of staking? Because then they're going to get less rewards from their share of the pool. And so isn't that a little bit of a perverse incentive? It's like the more efficient I make my business and my setup, the less margin I'm going to get. So I'm just curious in general, like what is the sort of internal algorithm, that you're thinking about in terms of how to reward these different modules and different stakers within the Lido marketplace?
Right. Yeah. So for vaults, for the staking vaults in general, so these basically would allow you to bring your own customers, right? So this is basically if the idea of like revenue share, like you have the idea of revenue share today, like if you bring users to the Lido protocol, then you can get a share of the revenue from the DAO. This is kind of supercharging that like times 10, because here every business can basically use the Lido protocol to create their own staking product, and then they can sell that, right? And like you can have in theory, like you can maybe have a circularity here where Lido itself is like driving stake to that. But it's mostly a way to actually tap into kind of the marketing and the business development and like the customers of a lot of other market participants who don't have the infrastructure to create their own staking setups, and who can really benefit from all of these integrations, and the deepest liquidity of any staking token in the market.
You know, we did an episode a couple of weeks ago with Paul Frembo of Morpho, and he was describing the different ways that he views protocols. And there are some DeFi protocols which look more like managed products, and there are some protocols which look more like neutral infrastructure. And it's kind of interesting to me that Lido is in a sense both here. That stETH has historically been a pretty managed product, but now you're modularizing it and actually, basically selling or allowing customers to interface with the infrastructure that allowed you guys to eventually to create stETH, which is pretty fascinating as a
it's effectively platformizing, right? Like the Lido protocol, and like right now there's 3 modules that can mint stake ETH, like against effectively their validators, and here you can way more parties can start minting in like a very kind of risk controlled way against that. And it basically allows like new products to be built on top of this, and in a way that really aligns also the incentives between stake ETH holders and the new vault operators, basically, because they would pay a fee that would then go to stake ETH holders.
Okay, Hasu, I've got a question for you. And this was actually, now I'm remembering this, Miles and I speculated a little bit on this on the LST season about whether or not when you're looking at the staking router, is this going to be a world of 7 vaults where there's an institutional vault, a whitelisted vault, a community, DVT, whatever, or is this a world of 1,000 vaults where you have a maker vault, a Aave vault, etc.? And it sounds like what you're describing is the world of maybe not 1,000, but many more customized vaults. Would Lido ever consider, do you think, an option to whitelist for a project to whitelist its own LST, use the staking router not as an opportunity to necessarily mint stETH, but mint some other more customized whitelisted LST?
It's a good question. I would need to think kind of more about the incentives of that. Like, I mean, what you're describing is basically where you're using some of the Lido infrastructure, but you're not using the token, right? And I think, I mean, we don't like the Lido protocol can't really control that, right? Like you can just make the vault using Lido, but then you can just mint your own token on top. So I think that seems possible to me. Yeah.
Interesting. Okay, final question for you on the token front, the LDO token front. So, this is one of those, I feel like this is a question which is coming up more and more because there is this, regime change in the US, and there's this, everyone's all bulled up on American Dynasty, American DeFi, etc. And you're starting to see protocols turn on the fee switch. So you have a proposal, I think Wintermute put through a proposal to turn on the fee switch for Athena, for staked SUSDE holders. There's been a lot of speculation for a long time about whether Uniswap is ever going to turn on their fee switch. And I think what's been holding some of these protocols back is fear of being able to secure a US-based regulation. And so I would be curious just how you think generally about the role of LDO within the Lido protocol. And then, I would love to get your thoughts even before we get to how LDO is going to evolve past just being a governance token. What your thought is on returning capital to token holders in general via fee switch. I know we've talked about this in the past before, but just almost from a higher level, zooming out, like, what do you think about that as a concept?
Yeah, so I have a few high level points on that. Right? When you have a protocol that is, you have a DAO, when you have a protocol that's governed by a DAO, which is governed by token holders, it's very clear that there is some kind of social contract here, right? Where the token holders basically should make decisions that are in the long-term interest of the protocol, but at the same time they need to be like rewarded for that in some way, because you want to attract like protocols that like align the incentives of their token holders with like the incentives of the protocol and its users, are just going to be more successful in the long term, right? And when you have the governance component, this is something that you don't really have maybe as much in outside of crypto, but these systems are like really really decentralized in the way that like whatever is voted on chain is actually law. There's nothing that you can do to prevent that, right? And we can talk about how dual governance changes this equation in a very positive way, but still the LDO token holders have the power to change contracts in the Lido protocol, right? And it's a very important duty. And so I think it's good to kind of strengthen that bond here and make sure that like people feel very long-term aligned. That would be the first thing, right? So you like this kind of linkage is generally good, and you want to attract people who take like a very kind of long-term view on the protocol. So the second thing is, can you actually do something? Like what are actually your options for like aligning these incentives? And like regulation plays a role here for sure. I think we've seen that in discussions in many other protocols. And I think it's generally good to have more options here. Right? I think it would be better for investors. It would be better for the protocols and the users if it was possible to have, to like not be able to do certain things just because maybe it makes it like tough in terms of regulation. And that kind of brings us to the third point, which is like, you should be aligning the incentives and you're legally allowed to do it, but like how exactly do you do it? Like, do you like share revenue? Do you share profit? And what timing do you do it? And I think I'm a big kind of subscriber in the idea that like you should first be thinking about growing the pie before you think about like how to divide it. And like the idea of like returning money to token holders, like giving it to token holders, should generally be what you do when you're like your options for reinvesting that capital to growing the protocol and strengthen it and making it better, they are all depleted, right? Like you have so much money that you don't really know what to do with it, and you think that growing the business, growing like your use cases is not really an option. And so you're looking at this maybe as a cash cow where this is going to be disrupted on some timeline, and we can keep it steady, but we can't really grow it or anything. And that would be the time when you want to think about returning this money, right? But when you look at not just at Lido, but at all of these protocols, is it like, if you kind of applied this more like classical lens of capital allocation to it, is it the right time for any of them to return capital? Like the answer would be obviously no, right? Crypto is growing at such a big speed. Like the market is changing all the time. They have really big costs, like fixed costs of like constantly shipping like a new version of the protocol, because the market is changing and the tech is changing. And if you're not changing with it, then you're gonna get basically left behind, right? The idea that the underlying blockchain is changing, and like all the time you have new ways basically of making the system better, which is like we all agree that the infrastructure and like the tech is not yet mature, but it is maturing every year. So you need to somehow pass these improvements on to users and give them new options, right? So you have very high costs. These protocols are very young. They're growing very rapidly. Crypto itself is growing very rapidly. There's constantly new types of users coming in that maybe you're not already serving, or like what the user wants is changing. And it's just very clear that like you should be thinking about reinvesting and kind of growing the pie, and not think about how can we really like extract the maximum amount of money over like 2 years, right? That would be suicide. But like why do I think people are still, why is this such a big topic at all for folks? And I think there is this social contract that I was touching on in the beginning. I think a lot of people don't really feel that it exists, right?
Yeah.
It's they it's this meme where you're going to the ATM at the end of the cycle and you're like trying to withdraw your money from crypto, and it says it's just magic internet money. What did you think? Like did you think you can actually withdraw this? And I think people have a very similar feeling about DeFi and like DeFi tokens, that it's quote unquote just a governance token, even though like governance is very valuable, right? Like the governance can decide whatever it wants in this like very decentralized way. But yeah, like this is not, I think, not something that people really feel like. And so I think it's almost like people want to do it once just to see that it's possible. And I think then like maybe more of a like realism about what you should actually do can kick in. I mean, I think there's plenty of short-termism, like not just from investors, but also from projects themselves. They have maybe their 2-year vesting schedule, and they don't care what happens in year 3 or year 4, right? Like if you're in that situation, what you should be doing is like, really pumping the price of your token, like, use incentives to pump your revenue, to pump the price of your tokens, then put like some kind of buyback on top, even though like your issuance is even outstripping that, and then like exit your tokens, over like, like as soon as they vest, etc. Like I think we've seen this playbook like used plenty of times. So yeah, like some parts where this is used is surely just to like pump like a particular token. But even for those who are very long-term incentivized, I think you really have this like, okay, I need to feel that this is actually real. Like this token that I'm holding is actually valuable. Like you can actually redeem it for something, or like you can actually there's actually some linkage here between this protocol that exists, that I'm governing, and like my kind of outcome that I get.
Yeah, I completely agree with all of that. I think to maybe steelman the argument for a second here, because I'm ultimately in the camp that you're in, which is it doesn't make sense to be returning capital to token holders at this stage in the life cycle where most of these protocols are, is that unlike equities, first of all, there are so many success stories of equities running this playbook, or companies running this playbook, right? Of you build up a network effect, and Amazon is a great example of this. For many years they were deeply unprofitable. They just reinvested everything back into the business, and they built up this amazing business, and now they're in a place where if they wanted to, they could return mounds of cash flows to shareholders. Right. And so there are lots of examples that has been proven, in your words, like many times, and we just haven't had that so much in crypto. The other thing too is equities and tokens are not the same thing, right? You have these in theory, not all equities are like this, right? Facebook is a good example of something. There's no dividend and actually no voting rights or anything like that. But for most equities, you actually have these rights, and so you don't need to question these sorts of things. But in tokens are kind of a low trust environment, and I agree. I think it's reasonable for people to say, hey, there's no precedent here that I'm going to get anything back from my token investment, so I want a little bit of proof here. So I totally understand that. On the other hand, I think the guiding force should be exactly what you described at the beginning. This is a capital allocation question, and ultimately, it's kind of bearish if you basically, when you're returning capital to token holders, what you're saying is, I don't have a higher ROI investment opportunity organically in my business, which is not good. That's not good. You should be able to find higher ROI growth type opportunities. And so I don't know. And also I think empirically, even there are examples of protocols that have tried to return cash to token holders, not necessarily, mostly through buybacks, right? And like the perp dexes are probably pretty good to look at around this. I mean, I feel like especially during bear markets, people just, because there's a lot of disillusionment, people fall back on this idea of cash flows, and they're like, what produces cash flows? A perp dex. Oh, and Rollbit's doing buybacks. Like Rollbit is the next thing. And it runs for a little bit and then it tanks. And Hyperliquid's doing that now. We'll see. They have no buybacks or anything like that. We'll see Hyperliquid's a funny protocol in general, but
I think
I'm
have,
with.
right? They have buybacks actually.
Do they? Okay, I
I
don't
think
know.
so. Yeah.
They're
Yeah.
yeah. So
Yeah. I don't know. Maybe with these things, it's like the acknowledgement that you can't build a really durable moat as a perplex for whatever reason, and
yeah,
so you just want to like max extract on like some short period of time.
yeah.
And maybe that is correct, but yeah, I really don't think so, right? I mean, the prime example of this is probably Maker, like now Sky, which has been basically buying back MKR for years, and it's like, yeah, it's also been sitting at like 5 billion DAI like in circulation for the same number of years. It's like, are you really telling me that you don't know what to do with this money? That like the stablecoin market has in this time grown from like 50 billion to like 250 billion, and you're like you're steady, right? And you're not growing at all. And it's just such dramatic mismanagement that this is almost painful, you know. So yeah, I wish people would like. I mean, we have the examples of like the stuff going wrong, even in crypto, even if it's like relatively short history, and I wish people would pay more attention.
Well, Hasu, we've already gone. I had a whole other line of questioning for you, but I'm looking at the clock and we've gone about an hour and 45 minutes here. So I think, we're going to do an episode in 1 or 2 months here.
Yeah.
And so maybe we can take some of the more like Ethereum specific DeFi questions that I had lined up for you then, and maybe leave the listeners with a little something to look forward to. But before we sign off here, can you just give us whatever you are, don't reveal any state secrets or whatever, but anything that you can tease us maybe a little bit about Lido v3, and that can set us up for our next conversation.
Yeah, so I think first of all, dual governance, I think is going to go to a DAO vote. It is done. It is passing audits. It's formally verified. And it's going to go to a DAO vote. Sometime in I think by March at least. So it's getting very, very close. And I'm personally extremely excited about dual governance. It is the first of its kind. I think a DAO that is, it is governed by token holders, by LDO holders, but it just giving this very explicit, right to exit, to pause the protocol and exit to staked ETH holders, and in this like bicameral way. And I think it's like such a good example, really, of what crypto can do, like designing these new systems that maybe have been kind of theorized, but it is really like creating like net new rights for different groups. And yeah, I think I'm very, very excited for that to go live. It's like been on the roadmap for 2.5 years or something, and yeah, this would be a massive milestone. And then, yeah, I think probably by that time, or like very, very, very likely by that time, there would be more info about Lido v3. It is the staking vaults, but it's also more than that. I think it's a very, very compelling and synergistic vision that turns Lido from basically just being staked ETH to this platform where anyone can create, staking products on top of Lido infrastructure that also benefit from staked ETH liquidity and integrations. And there's a whole range. We didn't get to talk about that very much today, but there's a whole range of use cases that I think you can really point to and that you can build on this that are very, very exciting. Some are related to the institutional market, some are related to restaking, some are related to leverage staking, some are related more to like basically unlocking these like protocol to business opportunities where someone has a lot of customers and they want to offer staking to them, maybe using a specific setup, and they don't have a good way of doing it today. And so yeah, I'm personally very bullish Lido for 2025.
Same. Well, also, it's always a pleasure to get you back on the show, my friend. And yeah, we'll follow up in a month or two here, whenever we're ready to unveil or talk in a little bit more detail about V3. So it should be a ton of fun. And and yeah,
Can't
as
wait.
mentioned, I know we're recording this on Christmas Eve here, and I believe it's about 5 p.m. or 6 p.m. Your time, Christmas Eve. So I'm gonna let you go and enjoy some much deserved time with your family. And yeah, we will happy holidays, my friend. And yeah, we will reconvene in the new year.
Yeah, happy holidays. Merry Christmas, and yeah, see you in the new year.
All right, Merry Christmas. Cheers.
Merry Christmas.